Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in this week's video, I'm going to cover share buybacks. So we're briefly going to touch on what they are, like why companies do them. And I'm also going to go into looking at how they affect the financial measures, because this is one of the important things you need to consider when you're looking to invest in a company, because share buybacks will actually change certain financial metrics. So let's get on with the video. So a share buyback is pretty much how it sounds. It's when the company goes and buys back its own shares. This is also known as share repurchasing. And most of the time what they do is they go to the open market and then buy the shares back at the current market price. And the main effect this has, obviously, it kind of reduces the number of shares outstanding. So that means that the existing shareholders actually all get a slightly increased percentage ownership of the company. So we can go and look, just a quick example I put together. So if a company has 1 million shares outstanding and I own 1,000 shares, then my percentage ownership in the company is 0.1%. So we can look at how this changes once the company repurchases stock as well. So if the company now goes out and repurchases 200,000 shares, that means now there's 800 shares outstanding. I still own 1,000 shares, but my percentage ownership has actually gone up now from 0.1% to 0.125%. And in actual terms, I've increased my ownership in the company there by 25% without actually doing anything. And companies will do share buybacks for a number of different reasons. One of the main things is they want to return value to the shareholders. And as I illustrated in that example, that shows how they can do it. Another way they return capital to the shareholders is through dividends. So obviously the difference being with a dividend that the company will pay you usually quarterly an amount. So obviously in that case, you're actually receiving the cash amount into your brokerage account. So the thing to remember here is that because the company's already paid tax on the earnings and once this goes to you, you will also be liable for taxes on the income from the dividend. So it's kind of like a double taxation of it, and the same doesn't happen when you're doing share repurchases, because you're not actually receiving money. It's just that your percentage ownership will slightly change as the number of shares outstanding is reduced. And actually buybacks were illegal until the early 1980s because it was considered a form of stock market manipulation. So it's only really in the last sort of 20 or 30 years where we've seen significant changes in that. And obviously, if you look at over the last 10 years in particular, the amount of share repurchases has actually been significantly on the rise with a lot of the bigger companies. There's a number of different reasons why companies do buybacks, but we'll go and look at some of the good reasons and the bad reasons now. So one of the good reasons a company would do share buybacks is they've got excess cash and they can't kind of put it to use in a more efficient way. So they might have be a mature company and reached the point where they can't kind of increase the speed of their growth. They've spent all they can on research and development, maybe capital expenditures. They've kind of done everything they think they can do to reinvest into the business and grow it faster, and now they've got an excess amount of cash which they don't have any use for. And you want to see the repurchase happening when the company is actually kind of below its intrinsic value. And obviously this kind of the same thing applies when you're an investor in a company. You want to buy the stock when it's below the intrinsic value, so it stands to reason that you would expect the company to do the same. So these points tie together because obviously they've got an excess in cash, but you really only want them to spend that on share repurchases if the company is below the intrinsic value. And if we now look at the bad reasons for it, it tends to be a few more in actual fact. But on the flip side of what we mentioned before, if the stock is overvalued, then a company could make better use of the money for other investments. So the company can repurchase a lot more shares with the same amount of money if the price is lower. And this returns more value to the investors because it changes the percentage ownership by a greater amount. And one of the important things for share buybacks is sometimes companies can do this to actually artificially inflate their numbers. It's always good to look at the whole number from the report, from the net income, rather than looking at it as just the per share amount. So for example, a company might have seen declining earnings in the last few years, but if they've actually continued to repurchase their own shares, depending on the rate that they've done that, the actual earnings per share might have still been rising, even though the actual earnings in real terms has gone down. So this is one of the things you need to be a little bit careful of as well, and I'll cover that a bit later on in the video. Buying back shares also has the effect of causing the stock price to rise in the short term. This can often benefit executives if their compensation packages are tied to share price. So this you need to also be careful of, because if it's in management's interest to increase the share price, then there's certain ways that they can manipulate this so that they hit their bonuses. And another bad reason is to keep up with expectations from investors that the company is going to continue doing repurchases, because some companies will just keep doing repurchases regardless of how much the share price is, or even they might take on debt to maintain these share repurchase programs. So you need to be careful of that. One of the most important things is the effect that share repurchases or buybacks have on the financial metrics. So I'll give you a quick example of earnings per share. So in this, we've got earnings of $10 million and 1 million shares outstanding. So that gives us $10 of earnings per share. So the earnings remains the same at 10 million, but now the company's gone and repurchased 200,000 shares. So there's actually only 800,000 shares outstanding. So if we take the earnings and then divide it by the number of shares outstanding, now we get an earnings per share of 12.5. And we can see that actually now we've just increased our earnings per share by 25%, and all that's happened is the company has repurchased the stock. Nothing's actually changed with the earnings. The earnings have remained exactly the same. And let's see how this affects also the balance sheet of the company. So in the balance sheet, we want to see the assets balanced with the liabilities plus the stockholder equity. So if we've got $100 million in assets, and our liabilities are 50 million and our shareholder equity is 50 million, that balances out because we've got 100 million on one side and 100 million on the other side. And now if the company goes and spends 20 million on repurchasing its stock, so now we've got 80 million in assets and we have the same amount of 50 million in liabilities, but the shareholder equity has now been reduced by the same amount that we spent on the share repurchases. So the share repurchases was 20 million, so 20 million is taken off the shareholder equity. So we can see there that after the buyback, there is less equity in the company, but there's also less shareholders to have a share of the equity. Now we can also go and look how this affects our return on assets. So this is shown before the buyback. So we've got 10 million in earnings, and then we've got 100 million worth of assets. So we take the 10 million, we divide it by the 100 million, and then we get our return on assets, which is 10%. So now we go and spend 20 million on repurchasing our stock. So our earnings are still 10 million. Our total assets are 80 million. So we take the 10 million divided by the 80 million. And now our return on assets is 12.5%, which you can also see is an increase of 25% based on the previous number without actually making any changes. Finally, we'll go and see how it affects return on equity. So same case, 10 million earnings, our equity is 50 million. So we take our 10 million, we divide it by the 50 million, and we're left with a return on equity of 20%. So then we go and spend the 20 million on repurchasing the shares. Doesn't affect our earnings are still 10 million, but now our equity amount is 30 million because we've reduced the equity in the company. So then we take our 10 million divided by our 30 million, and we end up with a return on equity of 33%, which is actually a 67% increase on what the number was before. So this just kind of gives a quick illustration on how share repurchases can affect the numbers, and it's something you really need to keep an eye on when you're looking into businesses. It's always good to kind of track over time, look at the number of shares outstanding, and if you can see obviously year on year they're decreasing, then you can just go and check what's happened to your earnings per share, return on equity, return on assets as well, and see how that ties together. So let's take a look at the things we need to watch out for with share repurchases. So we need to keep an eye out if the company is buying back their shares above the intrinsic value. And we don't want to see the company taking on debt just to continue with a share repurchase program. Also, we need to keep an eye out to see if the buybacks are being used to artificially inflate metrics such as earnings per share. And obviously, also buybacks can increase the value of the stock options, which is part of the company's management or executive compensation plan. So you can keep an eye out for compensation. You can actually look at the proxy filings and also websites such as salary.com. They'll quite often give you the information of like the CEO, what their salary package is, and their like share options and things like that. And we're not saying this is necessarily a bad thing. It's just something you need to keep an eye on. So I'll just kind of summarize the main points. Obviously, share buybacks are not necessarily a bad thing as long as they're done for the right reasons. If the company doesn't have a better way to spend the cash that it's got available, then obviously returning the money to shareholders is a good way for them to use up the excess cash. But of course, ideally, we want to see them repurchasing the shares when the company is undervalued, because we don't want to see that they're spending a large amount of money when the company is overvalued because they can only purchase a smaller amount of shares. And the main implication here really is just to consider how the buybacks affect the financial metrics, and just to know what you're looking for when you go into that kind of thing, and not to get too excited if you see there's a crazy increase in the earnings per share or the growth of returns on equity and things like that, because this might actually be artificially inflated by the buybacks. So this is something just to keep an eye on really. So that's it for the video. I hope you enjoyed it. If you did, please give us a like. Also consider subscribing to the channel as well if you haven't already, and hit the notification bell to get notified of any future videos that I release. So also let us know in the comments what you think about share buybacks. Is it a good thing? Is it a bad thing? Do you think there's better ways the company could spend the money? Leave that in the comments. I'll be interested to see what you've got to say. So thanks for watching, and I'll see you in the next video. Cheers.